Hi everyone, happy 2022. I hope you're having a great new year thus far. I wanted to shoot this video and send it out to you and just address a concern that you or maybe your clients may have about this rising tide of inflation that we're feeling. You see it everywhere, at the gas pump, at the grocery store, car prices, everything, right? And not to mention interest rates, of course, long-term interest rates, mortgages. So I've got a solution that you may want to consider for this. And I've seen this happen in my career over the last 20 years. I've seen as rates ebb and flow, and as they come up, we see the entry of different loan products or products that may have taken a back seat in the past, but now are taking a more prominent or could take a more prominent role. And one of these is the adjustable rate mortgage. Okay, so before you hit stop on your on the video here, hear me out, okay? Sometimes that ARM is like a nasty word, or a nasty acronym. It's really not a risky loan if you're looking at the right loan products. And the one specifically that I would recommend right now is a 10-6 ARM. So a 10-6 ARM, if you're not familiar with this 10-6 hybrid ARM just means that it's fixed for 10 years. And then every 6 months after that, it can adjust. Most consumers will plan on having it up to about 10 years, and they'll look for opportunities maybe late in that 10-year, 8, 9, 10-year period to look at refinancing that loan to get into a fixed rate, or they may just want to go into another 10-6 ARM again. It can make it a very affordable option because interest rates have risen in the past month. A month ago, they were 2.99%, basically high twos. Now they're about 3.8%. So we've gone up 3/4 of a point, 7/8 of a point in a 30-day period. That's a very quick time frame. So again, that's going to be a concern for borrowers that have been looking over the last month or two because their interest rate's going to be higher. If you look at a 10-6 ARM today, that 10-6 ARM rate is closer to about 3.1%. So you're saving almost 3/4 of a point by choosing that option as opposed to a 30-year fixed. Great solution for borrowers that are sensitive on their payment, and one that you may find valuable in passing along to them. Hopefully that information is helpful to you. Just as a side note, if they do go full 10 years on this loan, it'll pay down their principal about 25%. So if they started with a $400,000 loan, they'll be down to about a $300,000 loan. And if rates were high in that market, they could always do another adjustable rate mortgage, or we could look at refinancing to a 30-year fixed, even if rates were a little higher, but now they're borrowing with a $300,000 loan amount as opposed to a $400,000 loan amount. So that's going to make it quite a bit more affordable for them as well. If you've got any questions on this, or your clients have any questions, feel free to pass this video along to them or any associates where you think it would be helpful to them. Or feel free to just call me or send me a text or email me. I'm always happy to help, and really appreciate you taking the time to watch this video, and I hope you have a great week. Take care.